67 million ounces. Not a rumor, not a Telegram prediction. That is the Silver Institute's official 2026 forecast, backed by Metals Focus, the same research firm global banks use when they want a clean read on precious metals. 67 million ounces. That is how much more silver the world will consume this year than it will produce. And today, February 26, 2026, silver is sitting at $90.75, down from $121.64 on January 29th, a 26% crash in under 4 weeks, in a market with a documented, published, verified structural deficit. If you think that makes sense, stay with me, because by the end of this video, you won't just understand why it doesn't. You'll understand the exact mechanics of how they make it look like it does. Section 1. 6 years. 800 million ounces, gone. Let's build the foundation, not just 2026, the full picture. 2021, deficit. 2022, deficit. 2023, deficit. 2024, deficit. 2025, deficit. 95 million ounces, largest single-year shortfall in the modern data series. 2026, 67 million ounce projected deficit. Year 6 in a row, add those up. The 5-year cumulative deficit exceeds 800 million ounces, 1 full year of global mine production. Consumed, not recycled, not replaced, pulled from above-ground stockpiles bleeding quietly for half a decade. The Silver Institute, a trade body funded by the mining industry with every incentive to be conservative, wrote this in their February 10th report. The global silver market will continue to rely on the release of bullion from above-ground inventories, adding pressure to an already tight physical market. That is their language. Above-ground inventories being drained to cover a deficit mine production cannot fill. Year 6. Now let's talk about where those inventories actually sit. Section 2. The Comex vault is collapsing Comex registered silver, the physical metal sitting in exchange-approved vaults, actually available for delivery against futures contracts. This is the number that matters. October 2025, 167 million ounces. February 5th, 103 million ounces. February 11th, 98 million ounces. First time in recorded history below 100 million. February 19th, 88.79 million ounces, down 3.36 million in a single day. That is a 47% collapse in registered silver in roughly 4 months. Now here is the ratio that should make every futures trader uncomfortable. Comex March. Open interest represents roughly 500 million ounces notional. Registered silver available for delivery, 88 million ounces, 5 paper claims for every 1 physical ounce in the vault. And delivery behavior has changed completely. January 2026 saw between 33 and 49 million ounces of actual physical delivery. That is 7 to 10 times the historical January average. February delivery rate hit 98% of open interest. Historical normal is 5 to 15%. This is not a futures market rolling paper forward. This is a physical allocation queue. Buyers are demanding metal. The vaults are responding by shrinking, and the paper price is $90. Section 3. Shanghai is living in a different reality. While Comex prints $90, Shanghai is telling a different story entirely. As of this week, Shanghai silver maintains a premium of approximately $26 over Western spot. 1 metal, 2 prices, same planet. And before someone says arbitrage will close that gap, it won't. China implemented a new silver export licensing system on January 1st, 2026. You cannot cleanly move metal from Shanghai to New York to close a $26 premium. VAT complications, export licensing, capital controls make it structurally impossible. So what does a $26 premium mean? It means buyers in Asia are paying $116, $117 per ounce for physical silver right now, while New York prints $90. As of February 24th, 2 days ago, Shanghai Metals Market reported domestic spot silver ingot premiums rising above the SGE deferred contract, suppliers holding firm, buyers still paying. The tight supply from before Chinese New Year has not resolved. Physical demand in Asia is intact. The Western screen says $90. Asia says the metal is worth 116s. That divergence does not exist in a healthy market. Section 4. Mexico is on fire. Now something almost nobody in mainstream financial media is covering correctly. Mexico. Mexico is the largest primary silver producer on Earth. 202.6 million ounces in 2024, nearly 25% of total global mine supply. On February 22nd, 4 days ago, Mexican security forces killed El Mencho, head of the Jalisco New Generation cartel. Within hours, cartel gunmen began torching vehicles, erecting roadblocks across roughly 20 states, and launching attacks on civilian infrastructure. The removal of a cartel boss never ends violence. It accelerates it. What follows is fragmentation. Factions fighting for succession, rivals testing boundaries. The result, a surge in kidnappings, extortion, and targeted attacks on transport corridors. Exactly the conditions that shut down mine access roads. This is not theoretical. In January, before El Mencho was killed, Vizsla Silver's workers at the Panuco project in Sinaloa had 10 workers kidnapped, operations suspended, share price dropped 50%. That was before February 22nd. Now the entire country is in a new phase of instability. Mexico was supposed to lead global mine supply growth in 2026. That thesis is now under severe stress, and you cannot replace 202 million ounces from elsewhere. Chile, Peru, China, they produce silver as a byproduct. There is no switch to flip. The cartel crisis did not create the deficit, but it just poured fuel on a fire already burning. Section 5. How $90 exists in a 67 million ounce deficit. This is the most important part. I want to be slow and clear. The price on your screen is not set by the buyer in Mumbai or the solar manufacturer in Germany. It is set by the Comex futures market, where the overwhelming majority of contracts are never settled with physical metal. They are cash settled, rolled, closed without a single ounce changing hands. That means a market with a 67 million ounce deficit, all-time low registered inventory, a $26 Shanghai premium, Mexico in chaos, and a paper price that falls 26% in 4 weeks can all exist simultaneously, because paper and physical operate on different timescales until they don't. Now look at what happened around the January correction. As silver hit 121, concentrated short positions were building on the paper side. When the macro narrative shifted, Fed commentary, Scott Bessent attributing the rally to Chinese speculation, dollar strength. Those shorts didn't just profit. They amplified the decline far beyond what fundamentals justify. U.S. Treasury Secretary Bessent publicly called the rally a speculative blow-off driven by Chinese traders. That is the official government explanation, speculation, not the 47% Comex vault collapse, not the $26 Shanghai premium, not Mexico, not 800 million ounces of cumulative deficit, speculation. You decide which story fits the data. Section 6. Accident or architecture. Both sides. I always do this. If you only collect evidence that fits your conclusion, you are not doing analysis. You are doing religion. Scenario 1. Normal market mechanics. Silver hit $121. Leveraged longs overextended. When the macro environment shifted, forced liquidations cascaded. Margin calls hit livered accounts. The 26% correction is painful but explainable as speculative excess clearing. The deficit is real but doesn't prevent short-term paper dislocation. Physical fundamentals will reassert. It just takes time. Scenario 2. Structural suppression. Concentrated shorts appeared with precision timing as silver approached $121. 2 CME technical disruptions in 1 month after half a decade of clean operation, both clustered around settlement windows. SHFE suspended 25 trading groups in February alone for position limit violations. When exchanges enforce at that frequency, they are nervous about systemic risk. 5 paper claims per registered ounce. CME's order book wipe on restart benefits players with direct exchange access and algos ready in milliseconds, not the retail trader who finds out about the halt on a delay. Jesse Livermore wrote it a century ago. The player who controls the mechanics, the margin rules, the halt switches, the settlement protocols, does not need to move price directly. They choose when to remove liquidity and when to bring it back. The market's own structure does the rest. I cannot tell you which scenario is correct. I can tell you which one requires you to believe that multiple independent structural stress signals all coincidentally clustered in the same 6-week window for no connected reason. Section 7. The demand and supply picture. They are misreading the bear narrative right now. Industrial fabrication is declining 2%, solar demand is falling, speculative excess has cleared. Clean story, easy to sell. Here's what is inside that number. Solar thrifting is real. Manufacturers are substituting silver out of panel production to control costs. Note it. But AI infrastructure is expanding. Every server rack, every circuit interconnect, every high-frequency component in the data center build-out runs on silver. EV automotive silver demand is accelerating. By 2031, projected to account for 59% of industrial demand growth. Defense electronics procurement is rising across NATO. U.S.-Iran talks are live in Geneva today, February 26th, and military budgets globally are expanding. Physical investment demand is forecast to rise 20% to 227 million ounces in 2026, 3-year high. Western investors are returning after 3 consecutive years of outflows. SLV has seen fresh inflows even as Comex open interest declined, funds rotating away from futures into ETFs because they don't fully trust the delivery plumbing. On supply, global mine production hits 820 million ounces, a decade high. That is the bear headline. Context: 80% of silver is a byproduct of copper and zinc mining. You cannot produce more silver by deciding to. Output is not price responsive. Recycling will exceed 200 million ounces for the first time since 2012, all-time high recycling, and the market is still 67 million ounces short. Record recycling, decade high mine output. Sixth consecutive deficit. That tells you everything about the scale of demand. Section 8. What to watch. And the only honest conclusion. I sell nothing. No memberships, no Discord, no Signal groups. If you see my name on a paid service, that is a scam. You find me here and on X. So here is what to watch. Pull these numbers yourself. They are all public. Comex registered silver. Updated daily on CME Group's website. March 1st notice day is tomorrow, February 27th. Watch whether inventory stabilizes above 88 million ounces or continues to drain under delivery pressure. Shanghai Premium, track SGE AG T plus D versus XAG USD. If it narrows towards zero, physical pressure in Asia is easing. If it widens past $20, $25, $30, Asia is telling you something the Western paper price refuses to admit. Mexico security situation. Watch transport corridor reports, not just mine output headlines. A mine that cannot move product is not producing in any commercially meaningful sense. February Comex delivery rate, 98%. Historical normal is 5 to 15%. If March continues that pattern, 88 million ounces of registered silver is under enormous structural pressure. Now the full picture. February 26, 2026. Silver at 90.75, down 26% from 121.64 4 weeks ago. 6 consecutive annual deficits. 800 million cumulative ounces consumed from above-ground stocks. Comex registered silver at all-time lows, 88 million ounces, down 47% in 4 months. 5 paper claims per physical ounce. Shanghai paying $26 over Western spot, locked in by China's new export licensing. Mexico in active crisis 4 days after El Mencho's killing. February delivery rate at 98%, 7 to 10 times historical normal. SHFE, suspending 25 trading groups in a single month. 2 CME disruptions in 1 month after years of clean operation. Physical investment demand rising 20%, and the paper price is 90.75. You do not need to chant manipulation to look at those facts and ask a question. You just need to be honest about what the pattern looks like when all of it is in the same room at the same time. The deficit does not lie. The delivery behavior does not lie. The Shanghai premium does not lie. The draining vaults do not lie. The paper price might. Most people will not look at any of this, because looking forces them to confront the possibility that the system setting the price they see on their screen is running 5 paper claims per physical ounce, and that March 2026 is about to test whether that ratio holds. The minority who look will not need convincing. They will simply adjust. Invest with logic, not hype. Protect your capital. Respect the plumbing as much as you respect the chart. Drop OG John AG, or just OG in the comments if you actually checked any of these numbers yourself. That is how I know who is watching and who is just reading thumbnails.